Welcome to Old Square Tax Chamber's TaxSnax, a series of short talks that give you all the basic information you need to know about tax topics. I'm here today to give you a summary of the 2021 budget, and in the next week some of my colleagues will be presenting further TaxSnax on the details of several areas of the budget. We look forward to you joining us. The Chancellor's budget contained a number of pre-announced or leaked measures, as well as one or two that had been kept under wraps. Now, the budget did cover and make changes to the majority of direct and indirect taxes. However, the changes were somewhat muted. Now, before the budget, there was a great deal of concern about the significant impact that it might have for personal taxes. Capital gains tax was a particular concern, including concerns that there would be changes to the principal private residence relief and also changes to rates to match income tax rates. Similarly, in relation to inheritance tax, there was a great deal of concern that business property relief would be withdrawn or restricted. However, none of these worried for changes have actually come to pass in this budget, though no doubt there will remain areas of concern for the foreseeable future. However, there were still a number of other changes that are likely to significantly alter the tax landscape in the UK going forward. I want to look at first personal tax changes, then changes to corporation tax, before looking at indirect taxes and the interesting introduction of 8 free ports. Starting with personal tax, from a personal tax perspective, there is in fact not a great deal of change. The government seems to have been trapped between COVID spending and the need to manage that and its manifesto promises. So rather than increasing rates, it has frozen most personal tax allowances and thresholds. Starting with income tax, rates have remained the same. Instead, the personal allowance and the higher rate threshold, so that's the amount of earnings at which you start paying income tax and the amount at which you start paying the 40% rate, have been frozen until 2026. Now, what this does is it removes the incremental benefit that arises when these thresholds rise in line with inflation or rise straightforwardly. What it does is it pulls people into income tax and into the higher rate who would not otherwise have been pulled in had those thresholds kept moving up. The other thing to note is that the freeze is going to be for 5 years, so this is for a significant amount of time that the rates are going to be frozen. So while a freeze may perhaps be preferable overall for many, particularly those who are, say, already paying income tax or already paying at the 40 or even 45% rate, it does represent an opportunity for the government to claw back more tax from income. Similarly, and possibly with greater effect, the pension lifetime allowance has also been frozen until 2026. Now, this is important for a number of reasons. First, it represents a reversal of the proposal for the lifetime allowance to keep pace with inflation. Secondly, the government estimates that this measure, freezing the pension lifetime allowance for 5 years until 2026, will net £990 million, and it's going to do this in 2 ways. First, there will be those who choose not to contribute further to pensions because they've reached the allowance, and so if they contribute any more, they won't be able to claim the relief, and so aren't claiming the relief, and had the allowance kept going up, then they would have been able to add more to their pension and claim more relief, so it claws back some relief. And the second way in which it's going to net more tax for the government is that those who exceed the lifetime allowance but would not otherwise have done so because it kept moving up are going to have to pay tax. This is a particular risk to high middle earners who might have invested sensibly, and indeed if you look at the specialist press for doctors and dentists, they are quite concerned about this measure, but also it's going to potentially represent an increase in tax payable to higher earners. In both cases, if you have taxpayers who are being caught out by the freezing of the lifetime allowance, they should take advice on what alternative options might be available. Turning then to CGT, the annual exempt amount has again been frozen until 2026, and the same is true for the nil rate band and residence nil rate band for inheritance tax, also both frozen for 5 years. This is particularly interesting in relation to the nil rate band, which has not been increased since 2009. Now, some may remember that when the residence nil rate band was introduced, this was effectively suggested as a sort of alternative to increasing the nil rate band further. No similar excuse or SOP has been given here. Both the nil rate band and the residence nil rate band are frozen, the former at £325,000 for another 5 years. So if that freeze remains in place, the nil rate band will not have been increased for over 15 years. And you can see how, particularly with the way house prices have been rising, and if they continue to rise like that, which of course there's no guarantee, but if they do, this potentially pulls a large number of people into the IHT net over the next 5 years, with only limited further assistance from the residence nil rate band. However, in relation to property, there is in fact some good news, mainly for individuals, because the SDLT holiday for residential property in England and Northern Ireland has been extended until the 30th of June 2021. That means the nil rate for SDLT goes up to £500,000 until that date. From the 1st of July, it's going to be a nil rate band up to £250,000 until the 30th of September 2021, at which point, on the 1st of October, the nil rate band will return to £125,000, but that gives a significant period in which the housing market is going to benefit from having the nil rate of SDLT apply at much higher values. This is going to come as a huge relief to buyers and sellers who needed more time, as well as those looking to sell in the next 6 months. However, before we get too excited about SDLT on residential property, it's important to remember another measure that's coming into effect from the 1st of April of this year, which wasn't part of the budget measures, it was announced before that, but this is the 2% surcharge for non-UK residents buying residential property. So this means that from the 1st of April, any non-UK resident who's buying UK situate residential property is going to have to pay 2% more SDLT. So not all good news, but if you do have those sorts of sales and you can force them through in the next few weeks, that's a really good idea. Another point to remember that didn't make it into the budget, but that is important to remember because it's a new change that's coming in on the 6th of April, are the changes to the IR35 off-payroll working rules. Now, these changes primarily impact on public sectors and medium or large-sized private sector organisations. So if you have those sorts of clients, just check if they are using off-payroll workers, because these rules may well apply to them. What will generally be required will be for the public sector or large or medium private sector organisation to provide an employment status determination to the off-payroll worker. So they'll say whether they're employed or whether they're self-employed, and then there may well be payroll requirements dependent on that determination. So again, not part of the budget, but an important change that is coming up and something that you should take advice on now if you haven't already and you think it might affect you. Returning to the budget, the bigger changes, or the more exciting changes maybe, are however for corporates. So changes to corporation tax. The first of these is a new tapered corporation tax rate which will be introduced from the 1st of April 2023 with a headline rate of 25%. Now that represents a 6% increase over the current rate. However, it's not quite as bad as it sounds at first instance, because according to the Chancellor, only 10% of companies will pay this rate, because there'll also be a small profits rate, which applies to profits up to 50,000, and that remains at 19%. In between the small profits rate and the headline rate of 25%, the rate is going to taper for profits between £50,000 and £250,000. So you're only going to pay that £250,000 you're only going to pay that rate of 25% where you have profits over £250,000. And according to the Chancellor's budget speech, that actually only represents 10% of companies. So again, while this seems like a particularly far-reaching change, it may not be that bad, though of course there may be some difficulties with the taper provisions when we have them, so keep your eyes open for those. The next change, which actually applies both to corporation tax and income tax, is the temporary extension to carry back of trading losses, so that those can be carried back to the previous 3 years rather than only in the previous year, which is also good news for business. Now that's only a temporary measure, but if it's used in the period of availability, it could represent up to more than £250,000 of additional claims. And finally, there's been the introduction, again temporarily, of a so-called super deduction, which means that businesses can deduct up to 130% of the cost of investment in plant machinery. So they will actually be able to get a deduction of more than they spend, again for a temporary period, but for investment in the short term, this is really good news. So for corporation tax, obviously the new headline rate isn't brilliant, but that is tempered by the tapering for profits between £250,000 and £50,000 and the retention of the 19% rate for profits under £50,000. Additionally, you get these two temporary measures which give a temporary boost to businesses over the next 2 years or so. So not all bad for corporates, but again, you may need to take advice. So before moving on to indirect taxes, another really interesting part of the budget that doesn't fit neatly into sort of either into either direct or indirect tax is the pledge of £100 million for further and better investigations in relation to tax evasion and avoidance. Now this is apparently going to pay for 1,000 additional investigators. So one thing that you should be aware about in the coming years, in the next 2 to 3 years, is an increase in inquiries, COP9 investigations and similar, because there should be more power within HMRC to do that. Now, they may focus on COVID-related measures, but they are also probably going to focus on tax avoidance. So it's important to brush up on that area too. Obviously, that's not going to be an immediate effect, but do be aware that there's a probable increase in inquiry work is coming along. So turning now to indirect taxes and primarily to VAT, the reduced rate for hospitality has been continued until the 30th of September 2021. So this is a rate of 5%, which was introduced to help hospitality businesses with losses from COVID. The rate's going to remain at 5% until the 30th of September. There's then going to be an interim rate of 12.5% from the 1st of October until the 31st of March 2022. At that point, the rate reverts to 20%. So while that is good news, just make sure that your clients to whom this applies know what the rate is going to be at the appropriate time and that they're prepared well in advance and don't end up using the wrong rate. Finally, a really interesting measure is the introduction of 8 freeports across England. These freeports are going to have preferential rates of tax and regulatory regimes. This is another interesting measure for businesses and investment in the UK. We don't have many details of what they're going to involve yet, though there is details on what the SDLT position will be within these freeport areas. But come back next week, because I'll be talking about freeports and my other colleagues will be talking in more depth about the changes in personal tax, corporate taxes, and in relation to the 1,000 new investigators to combat tax evasion and avoidance. I hope this has been useful. Thank you for joining me.